investors are feeling confident as we head into 2025.
Yeah, this was a pretty unusual year historically. You don't have a whole lot of years where you've got pretty much everything's up. It just illustrates the point of diversification. Having not all your eggs in one basket, and proper asset allocation. Make sure you're contributing to the portfolio while you're working, because you're going to get different entry points at different valuations as you go.
As we head into the third year of that bull market, so coming out of 2022, we've had a positive 23, a positive 2024. As you can see, historically, that third year tends to be lower on average.
That's right. Yeah, markets are dynamic, and you see everything here since the great crash in 1929, and a lot has changed since then. We have a more active Fed. We have a lot more asset classes and investability by the public. Markets are different. So yes, we do care about historical, but we also care about what the market environment looks like and what it looks like 10 years out.
That third year can be a little slower, lower growth than the first 2 years of a bull market. But one thing that's interesting here, and we had talked about this in July and in the fall in our quarterly reviews, is that the earnings growth for the S&P 500 next year is actually projected to be quite significant. Analysts are forecasting a 10% growth in 2025. And particularly a lot of that growth is coming from those remaining 493 companies that aren't those magnificent 7 tech companies.
Every day consumers are getting up, they're filling up their gas tank, they're going to the grocery store, they're going to the hardware stores, they're going to some of those name brands, and those management teams are trying to pursue profits for returning profits to their shareholders in the form of either distributions of dividends or reinvesting in new services. You take a look at this, it's a pretty simple way of looking at the market. It's not all valued the same. And that's what you would expect. Markets are very dynamic. That's why you should be diversified, because not all sectors of the market are going to be priced the same at the same time. And certain sectors fall out of favor, some are in vogue. And that's why you need to be diversified, and why we maintain a diversified approach to our investing principles. Completely agree, Alec. And, a lot of times we get questions about, hey, is now a good time to invest? And, it's kind of like planting a tree. When's the best time to plant a tree? Probably today. And so being consistent with contributions while you're working and putting away for your future, you will be cost averaging in over the long haul into a variety of market environments and a variety of valuations. So trying to pick the right spot, we call that paralysis by analysis. And sometimes investors, get caught up in their own head where they don't ever get started.
Rates are going down, but I'm not seeing really any changes to the mortgage rates or, the bond portfolios.
Sure. So what we're looking at here is the short-term rate. It's the interbank lending rate, the Fed policy rate. And so that really just means your savings account is probably going to get adjusted in terms of rate. That's probably trickling down. It doesn't necessarily mean that your mortgage rate's going to come, because longer term rates are more of a function of how is the economy going to be doing, how is inflation going to be in the future. And so it's completely different. Expect that to be probably the case going into 2025, a little bit of a cautious approach that the Fed will take.
A lot of investors are thinking, oh, hey, let's just, copy and paste 2016 to 2024. Trump's now in office. He's going to enact his new policies. It's going to be the same playbook. We're going to run the same plays. Well, things are quite a bit different, from 8 years ago.
When you take a look at this, I think what we need to think about is going forward, what do the next 8 years look like? Which is 8 years is a typical market cycle. It's actually 7 and change, but a lot happens in those 8 years. A lot happens, and there's things that are completely out of our control, macro global events as well as economic events. And so the main thing is sticking to a diversified investment plan, being consistent, living within your means, and getting tailored advice for your situation as the environment does change.
This is a great example of how dynamic not only the economy is, but financial markets and your own personal financial situation. I mean, this is 8 years, and a lot of times we're planning with clients over a 25 to 30 year retirement or a 30 to 40 year working life and retirement. And that's why it's so important to, not only monitor your investment strategy and controlling that to an extent with the risk profile of your portfolio, but also being dynamic and engaging with us and your advisory team on changes to tax code, changes to financial planning strategies, and implementing those small changes along the way to take advantage of the dynamic market environment that we're living in.